Imagine opening up a financial report, right? And you see a company that loses um, $1.38 for every single dollar it brings in.
Yeah, that's a tough read.
It is. I mean, its current balance sheet basically looks like a crime scene,
Yeah.
and they are completely abandoning their original business model.
Right.
But despite all that, there's this very loud, very influential corner of Wall Street that genuinely believes this stock could, more than double in the next 6 months.
Which sounds crazy, but there's a real logic to it.
Exactly. So welcome to today's deep dive. Today we're looking at a stack of buy-side equity research on a company called Keel Infrastructure. They trade on the NASDAQ under the ticker Keel.
Yep, Keel.
And our mission for you today is to really look past the flashy headlines of the AI boom.
Yeah.
We hear so much about the microchips and the chatbots.
Oh, it's nonstop. Everyone is talking about NVIDIA and ChatGPT.
Right. But we are bypassing all of that today. We're ignoring the software, and we are focusing entirely on the gritty physical bottleneck of the future, the energy, the land, and the water.
Because that's really the ultimate hidden mechanic of this whole AI gold rush. I mean, Keel is a $2.62 billion company.
Wow, okay.
Yeah, and they're currently trading at around $4.68 a share. And what this equity research details is it's a massive high-stakes corporate pivot.
It's essentially the picks and shovels analogy, right? Like back in the 1849 gold rush.
Exactly.
The people who actually made the real money were the ones selling the shovels. In the AI rush, NVIDIA is basically selling the shovels. But Keel's doing something even more fundamental.
Yeah, they are trying to corner the market on the actual land and the water that you need to do the mining in the first place.
Because you can't just build an infinite digital brain in the cloud. I mean, the quote-unquote cloud is actually a massively heavy, incredibly hot, very power-hungry building.
Sitting on the ground somewhere, drawing massive amounts of electricity.
Right. So to understand why Wall Street analysts are watching Keel so closely right now, we actually need to start by looking at what they are running away from.
Yeah, they're past.
The research outlines that Keel is fundamentally transitioning away from being a legacy Bitcoin mining operation.
Which is an immediate red flag for a lot of institutional investors. I mean, it totally explains those horrific trailing financials you mentioned at the start.
Yeah, let's talk about those. The report highlights a negative 18.84% gross margin.
Wow.
And then that staggering net margin of negative 138.54%. I mean, they are burning cash at a spectacular rate.
They really are. And it's all to fund this massive transition into high-performance computing, or HPC, and AI data centers.
See, if I'm looking at a balance sheet bleeding cash like that, my first instinct is, this is just a sinking crypto ship.
Right, trying to rebrand.
Exactly. Slapping the buzzword AI on their pitch deck just to stay afloat. We saw like a dozen companies do exactly that during the dot-com bubble.
And again, during the crypto boom, yeah.
But this equity research argues that these negative margins are actually just a lagging indicator.
Right, they reflect the cost of tearing down the old house, not the actual value of the new one being built.
Okay, that's an interesting way to put it.
It's a crucial distinction. You have to look at the structural difference in the business models. Legacy crypto mining, it's just highly volatile and deeply commoditized.
Because your profitability as a Bitcoin miner is entirely tied to the wild swings of crypto prices, right?
Exactly. That and the ever-increasing difficulty of the mining algorithms themselves, it's basically an arms race.
Where your hardware just depreciates incredibly fast.
Fast, yeah. And you have almost zero long-term revenue visibility. You're just at the mercy of the market.
You're on a roller coaster you don't control. I mean, if Bitcoin crashes tomorrow, your margins just evaporate instantly. It doesn't even matter how efficient your operation is.
Exactly the problem. But high-performance computing and AI collocation centers, they operate in a completely different universe.
That's so.
Well, you aren't mining a volatile asset anymore. You are operating highly specialized commercial real estate for supercomputers.
Oh, interesting. So it's a real estate play.
Basically, yeah. The business model shifts from speculative mining to signing long-term leases. We're talking leases that span 5 to 10 years.
With investment-grade tenants, I assume.
Exactly. The massive cloud providers, the hyperscalers, the Googles and Microsofts of the world.
And the research indicates that once these facilities are actually fully leased and operational, the potential gross margins can range from 50 to 70%.
Which is a massive jump.
It's huge. Going from negative 18% to positive 70% requires an insane barrier to entry. Why is an AI company willing to pay such an enormous premium just for floor space?
Well, because it isn't just floor space. The demands of training these massive AI models, it requires what the industry calls power density.
Power density. Okay, break that down for us.
So standalone data centers, like the ones hosting regular websites or your basic cloud storage, they simply cannot handle the heat and electricity requirements of next-generation AI chips.
The chips are just running too hot.
Way too high. You need specialized reinforced flooring just to hold the physical weight of these incredibly dense server racks.
Wow, I didn't even think about the weight.
Yeah, and you need advanced liquid cooling systems because traditional air cooling just can't blow the heat away fast enough. And most importantly, you need a massive, uninterrupted pipeline of electricity.
Which perfectly sets up the geographical ace in the hole that this entire buy-side report hinges on.
Right.
If Keel's entire future relies on successfully executing this pivot, they need a location that can actually support that kind of extreme power density.
And that brings us to their massive milestone, the Sherbrooke project.
Yeah, let's get into Sherbrooke.
So the research highlights a critical catalyst here. On July 15th, 2026, Keel secured municipal approval for a 96-megawatt power transfer and land purchase in Sherbrooke, Quebec.
And it's currently pending final provincial review, right?
Right, exactly.
Let's put 96 megawatts into perspective for you listening. That is not just plugging a few extra extension cords into the local grid.
No, not at all.
That is enough continuous electricity to power tens of thousands of homes. It is an industrial-scale power draw.
It's massive.
And the location, Quebec,
Yeah.
is arguably the most important detail in this entire report.
Yeah.
It really all comes down to the source of the electricity.
Yes. Quebec hydroelectric power is essentially the holy grail for AI data centers right now.
Why is hydro specifically so valuable?
To understand that, you really have to look at the massive problem facing the biggest tech companies in the world, the hyperscalers. Their AI models are incredibly thirsty for power, as we said.
Right.
But these exact same companies have committed to extremely strict ESG mandates, environmental, social, and governance goals.
So they've promised their shareholders and the public that they'll be carbon neutral.
Exactly. So they are essentially trapped.
They desperately need more electricity to win the AI arms race, but they can't just plug these massive new supercomputers into a grid that runs on, like, coal or natural gas.
No, because if they do, they completely blow up their climate commitments. It's a PR nightmare.
Historically, tech companies get around this by buying renewable energy credits, right? Like, they use dirty power, but then pay to fund a solar farm somewhere else to offset their carbon footprint.
Yeah, that's the old trick. But that is getting incredibly expensive, and public scrutiny over that kind of greenwashing is just at an all-time high.
People are seeing right through it.
They really are, which is why native clean power is just so valuable right now. But it actually goes deeper than just being clean.
How so?
Well, you might wonder, why not just build a massive solar or wind farm in the desert to power the data center?
Yeah, that seems like the obvious solution.
The issue is intermittency. Solar only works when the sun shines, obviously. Wind only works when it blows. But AI training models, they take weeks or even months of continuous, uninterrupted processing. If the power drops, even for a second, the training run can fail. And that costs millions of dollars.
So AI basically requires what the energy sector calls baseload power.
Exactly. Baseload.
It has to be on at maximum capacity 24 hours a day, 7 days a week. And hydroelectric power from a massive river system actually provides that perfect, consistent baseload without generating carbon emissions.
It's a structural advantage that is just incredibly hard to replicate. I mean, you can't just build a new river.
Right, you can't just invent geography.
And you can't easily bypass the local authorities either. Hydro-Quebec controls the grid up there.
Yeah.
So securing that 96-megawatt allocation creates this massive barrier to entry for any competitor who might want to set up shop next door.
Plus, isn't hydroelectric power among the cheapest industrial electricity sources in North America?
Oh, absolutely. It's incredibly cost-effective.
So Keel is essentially acting as a gatekeeper to a natural resource that the biggest companies in the world are absolutely desperate for.
Yes, they aren't just selling server space. They are selling native baseload clean energy.
Which solves the hyperscalers' biggest operational and public relations headaches all at the same time.
And that structural advantage provides a major margin advantage over US-based data centers, too, because those guys are forced to rely on expensive, gas-heavy grids or those costly carbon offsets we talked about.
So this is really the foundation of the bullish thesis in the equity report.
100%.
Okay, so they have the blueprint and they have the municipal approval for this absolute holy grail of power. But does Wall Street actually believe Keel can pull off the execution?
That's the million-dollar question, or rather the $2 billion question.
Right. If we follow the money flow and the market sentiment, the chart tells a very complicated story. Year to date, the stock is up over 100%.
Yeah, it went on an absolute tear earlier this year.
It hit a high of $7.37 back in June. But since then, it has pulled back significantly. It's dropped about 36.5% to its current level, around $4.68.
It is a chart that would give a lot of retail investors vertigo, for sure.
Oh, definitely.
Yeah.
But despite that sharp pullback, the analyst sentiment in this report remains incredibly aggressive. Recently, Citizens analyst Greg P. Miller initiated coverage on Keel with a $10 price target.
$10, yeah.
A $10 target on a stock trading under $5 implies an upside of over 113%.
That is a massive call from a major institution.
It really is. And there's another layer to this that I find fascinating. The research notes that over the last 90 days, insider buying, meaning the executives and directors who are actually running the company, shows a net positive of over 304,000 shares.
Right. The people closest to the actual operations are putting their own personal capital on the line.
Which creates a really interesting psychological puzzle for you as an investor. If you are looking at your portfolio and you see a stock that is pulled back almost 40% from its high in just a matter of weeks, your instinct is usually to panic.
Naturally. You assume the run is over.
Right. Time to get out before it drops further. But the insiders are buying heavily into that exact drop. My immediate thought is, are they just blindly catching a falling knife because they are, overly optimistic about their own company? Or is the market misinterpreting this pullback?
Well, if you synthesize the technical analysis provided in the report, it suggests the market is actually behaving quite rationally right now. This isn't a panic at all.
Explain that.
When a stock runs up 268% in just 11 weeks, which Keel did earlier this year, it fundamentally has to consolidate.
It needs to catch its breath.
Exactly. The most important metric to look at during a pullback like this isn't just the price action, it's the trading volume.
The number of shares actually changing hands every day.
Precisely. The report points out that the volume during this 36% drop has been shrinking significantly. It is currently hovering at about 2/3 of its average daily volume.
Okay, and why does that matter?
In technical analysis, when a stock pulls back on low volume, it suggests a healthy consolidation. It forms a pattern known as a bull flag.
Ah, a bull flag.
Yeah, it basically means the massive institutional holders who drove the price up in the first place aren't rushing for the exits. There is no broad sell-off happening here.
So the buyers have simply stepped back to wait.
Exactly. They are waiting for the narrative to become reality.
Because the story is phenomenal. But until there is ink on a contract, it's really just a story. The insiders buying those 300,000 shares are likely positioning themselves for the specific catalysts that the analysts are calling the AI jackpot.
Right, the jackpot. The first catalyst is the final provincial approval for the Sherbrooke project, which would completely de-risk the physical build-out.
It proves they can actually break ground.
Exactly. And the second, far more explosive catalyst is a highly anticipated signed lease with a major AI tenant.
That's the big one.
It is. The moment a hyperscaler actually commits to that facility, it validates the entire corporate pivot. It transitions the company from this speculative cash burn operation into a high-margin, long-term revenue generator.
And that signed lease is the trigger that potentially reprices the stock toward that $10 target.
Right.
But look, we have to do a serious reality check here. Whenever you see a stock trading under $5 with a target of 10, it means the market is demanding a massive premium for taking on this bet.
There is existential risk baked into that current price, for sure.
It sounds like a guaranteed home run when we talk about it, but let's lay out what could actually derail this entire thesis.
Yeah, the equity research is very clear-eyed about the bear case. They lay out 3 primary, potentially devastating risks. First, as we've touched on, is the pre-revenue cash burn.
Because Keel does not actually have a major AI tenant yet.
No, they don't. They are spending aggressively to build out this infrastructure, but the cash is flowing entirely outward right now.
To put it in perspective, they are acting like a commercial landlord, building the most advanced, state-of-the-art, eco-friendly shopping mall the world has ever seen.
Right.
but they haven't actually signed an anchor tenant. There is no flagship store committed to opening day. What happens if they spend hundreds of millions of dollars building out this 96-megawatt facility in Quebec, and the hyperscalers just decide to go somewhere else?
That's the nightmare scenario. If the lease negotiations stall, or if that provincial review gets bogged down in bureaucratic red tape for, say, a year, that cash burn rapidly transitions from being a cute lagging indicator into a very real liquidity crisis.
They are racing against the clock.
They absolutely are, and that clock is heavily influenced by the second major risk the report identifies, which is the convertible notes overhang.
Yes. This is a complex financial trapdoor that you see a lot in these highly speculative growth stage companies.
It really is a trapdoor.
Let's really break down the mechanics of an overhang for everyone. A convertible note is essentially a loan the company takes out to fund its operations, but the lender has a unique option.
Instead of being paid back in cash with interest, the lender can choose to be paid back in newly issued shares of the stock, usually at a predetermined price.
Right, which creates an incredibly dangerous dynamic for regular shareholders. Think of it as an invisible ceiling on the stock price.
Exactly, because if Keel secures the provincial approval, they sign a massive AI lease, and the stock price suddenly skyrockets, those debt holders aren't going to ask for their cash back.
Why would they? They are going to exercise their right to convert that debt into stock.
Because the stock is now worth vastly more than the original loan.
But when they do that, the company has to magically create millions of brand new shares out of thin air to hand to the lenders.
Which instantly dilutes the value of every single existing share on the open market. It just floods the market with new supply.
The research notes that investors currently seem willing to look past this risk, betting that the fundamental growth of the AI transition will just outpace the dilution.
But structurally, it acts as a penalty for success. It's weird. The better the news, the more likely the conversion, which immediately drags the share price back down.
It caps your upside. And that brings us to the third risk, which kind of amplifies everything we've just talked about: extreme volatility.
Yeah, the beta.
The report flags that Keel has a beta of 4.09. Explain beta for us.
So beta is a measure of how a specific stock moves in relation to the broader market. A beta of 1 means the stock moves in perfect sync with an index like the S&P 500.
So if the market goes up 1%, the stock goes up 1%.
Exactly. So a beta of over 4 means Keel is essentially 4 times as volatile as the market average.
It provides incredible leverage on the way up, sure, but it is brutally unforgiving on the way down.
Oh, absolutely brutal. If the broader tech sector has a mildly bad day and drops, say, 2%, Keel could easily drop 8 or 10% just on the background market noise.
Completely unrelated to their own business fundamentals.
Exactly. It's just market gravity.
Which fundamentally changes how you have to view this stock as an investor. The equity research is explicit about this. Keel is not a buy and hold forever retirement investment.
No, definitely not. You are not buying this to put it in a safe and check on it in 20 years.
Right. The analysts classify this strictly as a 3 to 6 month swing trade.
The entire valuation is tied to specific near-term catalysts. You are investing in a timeline here.
If the provincial review passes and a lease is signed within that window, the thesis plays out.
But if the timeline breaks, the thesis breaks. And the downside risk is severe.
That distinction between long-term investing and catalyst-driven trading is absolutely crucial for anyone looking at this sector right now.
It's the difference between gambling and having a strategy.
Exactly. So, bringing all this together, Keel infrastructure serves as a perfect microcosm for the reality of the broader tech landscape right now. We get so easily caught up in the magic of the algorithms, the software, and the artificial intelligence that it feels, weightless and infinite.
But this research proves that the future of digital innovation is entirely 100% dependent on physical, real-world bottlenecks.
You cannot build the digital future without pouring concrete, laying massive copper wires, and securing unbelievable amounts of water and power.
Keel is making a high-risk, high-reward bet that clean, abundant baseload energy is going to be the single most valuable commodity of the 21st century.
And when you look at the macroeconomic environment, that bet starts to look incredibly prescient.
It really does.
The research report leaves us with a fascinating macroeconomic puzzle to chew on. It highlights the current state of geopolitical instability, specifically pointing to conflicts like the U.S. Iran tensions and the maritime blockades severely impacting shipping routes.
Right, like the issues we've seen in the Red Sea. These aren't just political headlines, they are direct threats to global energy supply chains.
When cargo ships and oil tankers cannot safely pass through major maritime transit routes, the global price of conventional energy oil, natural gas, coal can just spike unpredictably.
Which makes the entire global power grid deeply vulnerable to shocks that are completely out of the control of the tech industry.
If you are a hyperscaler about to invest $3 billion into a new data center to train your next AI model, you simply cannot afford to have your daily energy operating costs double overnight.
Just because of a conflict on the other side of the planet.
Exactly. Which frames the ultimate provocative question raised by this deep dive. We spend all our time analyzing the technology itself, but in an increasingly unstable world where global supply chains are constantly under threat, how much of a massive long-term premium is the market eventually going to place on domestic renewable infrastructure?
Infrastructure that is entirely insulated from overseas conflicts.
Yes, because if you secure 96 megawatts of hydroelectric power coming straight from a river in Quebec, you don't care if a shipping lane halfway across the world is blocked.
The river just keeps flowing.
The power just keeps generating. It turns a local natural resource into the ultimate global strategic asset.
It creates a safe harbor for the most critical technology of our generation.
It really shifts your entire perspective. Everyone is rushing to build the smartest algorithms and the fastest microchips, but when the dust settles, the absolute power might just belong to the people who quietly cornered the market on the land and the water required to plug those chips in.
It's food for thought, for sure.
Thank you for joining us on this deep dive. We hope it gave you a new lens through which to view the physical reality behind the AI boom. Keep questioning the unseen foundations of our digital world, and we will catch you next time.